Hello students, this is lecture of working capital management. This is short-term decision making as far as financial management is concerned. As we have done earlier also, there are two decision making in financial management. One is long-term decision making and one is short-term decision making. Under long-term, we have already seen three important decisions. One is investment decision, that is capital budgeting. Second is capital structure, which is known as financing decision. And the third is dividend policy, which is also known as profit distribution. And the second important decision in financial management is short-term decision, which is also known as working capital management. So basically, we will be talking about what is the meaning of working capital. Working capital means the money, cash, or cash equivalent which we want on hand to run the day-to-day business, or the money, capital which we want to run your day-to-day requirement, to meet with the day-to-day expenses of the business. Let's see in detail what is meaning of working capital management. So just like we manage fixed capital, we manage the fixed assets of the firm which we are using for producing, manufacturing. By exploiting the fixed assets, we generate income, we make sales, but sometimes the sales are converted into debtors, and this debtor is a part of bills receivable, and the bills receivable is a part of current assets. So basically, assets management. Under asset management, there are fixed asset and current assets, and current assets are nothing but part of working capital management. We need to be very careful while choosing the sales decision, whether we are selling all our goods on cash basis, or whether we should provide some credit to the debtors, to the customers. If we force our customers to pay only cash, and if we are selling our business in cash, then it will be difficult for us to have to cater more number of customers. But if we start giving credit, definitely we can have more number of customers, but in that case, not all customers are paying cash on time, and there are some customers who might turn into bad debts. And that's the role of working capital management. How much limit we should provide to customers, how much limit we should give to our customers to pay cash, but for that limit we have to manage cash, and that's the working capital management. As you can see on the screen, there are assets, as I have explained in earlier slide. There is fixed assets and current assets, and now in this chapter we are talking about current assets, which is called working capital management. So as far as working capital is concerned, there are again two broad concept of working capital. One is called gross working capital, and one is called net working capital. So basically, a difference between current assets and current liabilities are known as working capital, and to manage our current assets and current liabilities is a part of working capital management. So when we are talking about only current assets, that is current assets, which means the cash or the assets which can easily converted into cash within 6 months or within one financial year, like debtors, bills receivables, inventories, prepaid expenses. These all are known as current assets, and these current assets can be easily converted into cash within 6 months or within 1 year or within the one accounting year, and that is known as only gross working capital. Now what does mean net working capital? The net working capital means out of current assets, when we minus our current liabilities. Now current liabilities are those liabilities which can be paid within one financial year, within one accounting year, or which can be paid in a short time, just like creditors, bank overdrafts, short-term loans, outstanding expenses like outstanding wages, outstanding salaries. These all are the expenses which we have to pay within one financial year or within the accounting period. That is known as current liabilities. And when we make difference between current assets and current liabilities are known as net working capital. Now, net working capital can be positive or it can be negative. When your current assets are more than current liabilities, as you can see on the screen, when your current assets are more than current liabilities, these are known as positive net working capital. And negative working capital means when your current assets are less than current liabilities, means our payment, our outstanding payments are more than our assets in the market are known as negative net working capital. So gross working capital basically focuses on optimizing the investment in current asset where a firm's hand can be on upper side, and net working capital focuses on uh, how much cash we should always keep on hand so that company will never face the liquidity problem, financial difficulties. Whenever our creditors are asking for money, we should have money on hand. The company should not lose goodwill because of unavailability of cash. So this is called net working capital. A company always tries to find out how much working capital they should have on hand. So whenever somebody asks money to pay, to repay, we should be able to repay. Now the next concept is called operating cycle. Operating cycle varies from business to business. But before understanding operating cycle means it starts from cash and it ends with cash. Business house require cash to purchase raw material. This raw material will be converted into work in progress, and this work in progress will ultimately be finished goods. So if we are able to sell our goods, the finished goods will be converted into sales. But if we are unable to make all sales of our finished goods, then finished goods will be part of stock, inventories. Finished goods, then inventories, and from inventories we can have sales if it is cash sales. If it is credit sales, then it can be debtors. From debtors, if they are paying cash, then the debtors will be converted into cash, or else debtors will give us bills receivable, they give us post dated check. So basically operating cycle depends on the nature of business. If the nature of business is manufacturing business where your funds are blocked into many categories like raw material, work in progress, finished goods, debtors, and all these things, so working capital cycle, or you can say operating cycle, will be lengthy, will be huge, and bigger the operating cycle, bigger will be the working capital requirement. But if your business house is rather than manufacturing, if your business house is a trading business where you are not going to manufacture anything, you purchase from a company and you are selling it to the wholesaler or retailers, so your working capital requirement can be small. From cash you require finished goods, and from finished goods you require another purchaser from you, that is wholesaler or retailer. And if it is a service business, third category, the working capital, or you can say operating cycle, can also be very small because there is no blockage of fund, there is no raw material. I'll be talking more about this service organization in the later slide. The next concept is of permanent working capital and temporary working capital, or we can also known as a variable working capital. So as we have done, working capital means the cash which we have, which we should have on hand. Again, the categories of this working capital are, there are some amount of cash which company always require on hand every month, like salary of manager, purchasing of raw material, payment of electricity bill, and other expenses. These are called permanent working capital. Whether company is working, whether a manufacturing process is going on or not, these expenses you have to make payment, and because of that, this amount which company require every month The amount which company requires each month to pay is known as a permanent working capital requirement. But there is variable working capital requirement also because of nature of businesses. Let's say seasonal business. If you are doing business of seasonal product, so in that case, the requirement of working capital can be variable. During the off season, you require less labor, and because of less labor, less raw material, require less working capital. And during the season period, the company require more working capital, the company require more labor, more raw materials, etc. For example, preparing crackers during the Diwali season, the stock of crackers, firecrackers, require more labor, require more stocks, and because of that require more working capital. So let's look into the permanent and variable working capital. A minimum level of current assets which is continuously required by the firm to carry on its business operation is referred to as permanent working capital. That is every month requirement, and as I said, it's a fixed electricity bill, manager's salary, not labor. Labor can be variable, but the manager, whether company is manufacturing or not, whether company is doing business or not, but manager is a full-time employee, and you have to make salary of this accountant, manager, and all this. So these are known as a permanent working capital. The fluctuating means the extra working capital needed to support the changing production and sales activities of the firm, referred to as fluctuating or variable working capital. So as we have discussed earlier, it's a seasonal business. When it's a season, you require more working capital. And as this, you can see this in slide on straight line, which you can see is known as a permanent working capital, and the zigzag line which is moving up down, which is shown as a temporary, or you can say fluctuating working capital. These are very important. These are known as a determinants, or we can also known as a factors affecting working capital requirement. Not all business houses, not all companies require the same amount of working capital. It varies from business to business, and there are some variables, there are some factors, there are some um, points which we have to take into consideration. And what are the variables which will affect the requirement of working capital? Number one is the nature of business. So as I said in 2-3 slides back, there are three type of nature. One is called manufacturing business, second is trading business, and one is called service business. So if it is a manufacturing business, like you are having refinery business, so you require cash to purchase raw material. This raw material will take minimum 2-3 months to convert final product, finished goods. So for this 2 to 3 months, your funds will be blocked. So your funds are blocked from converting raw material to WIP to finished goods, and your requirement of cash on hand will be huge. And during this 2 months, you have to maintain, you have to pay salary to the managers, you have to pay wages to the workers, you have to pay electricity bill. So that is called manufacturing business, and that's why the working capital requirement is huge. Let's talk about the second one, is called trading business, which is not manufacturing, which is purchasing from, let's say, a mall. So mall is not going to manufacture anything. Mall is going to purchase from the company, will keep in store for 1 month or 2 months or max 6 months. Customer will buy it in cash. So the funds requirement, or you can say the blockage of fund for trading business will be less as compared to manufacturing, but more as compared to service business. So in that case, trading business will require less amount of working capital on hand as compared to manufacturing business. And let's say the third one, which is called service business, let's say hotel, restaurant, transportation services. These all are the business houses. These all are the businesses where the blockage of funds are very minimum. Customers are purchasing the product, they are using the product, and they are paying on cash. When you go to restaurant, you eat food and you make payment just after having the food, just after enjoying the food. That's why the requirement of working capital, the blockage of funds will be very less. The debtors are very less. Bills receivables are very less. Second, market and demand. If there is huge demand of your product, you require more money to purchase more production, to have more working capital. So if market is huge and the demand is huge for your product, you require more working capital, and vice versa. Third point is technology and manufacturing policy. If your company is a, there are two kind of company. One is called labor intensive and one is called capital intensive. So the company which is labor intensive, having less technology, you are not having too much of technical machines, so your investment in plant and machinery will be very less, but your company is working, your manufacturing depend on the labor, the more number of labor, and that's why you require more fund to pay wages, and that's why your working capital will be huge. But if you have more machines, if you have more information technology where you have less labor but you have more machines, in that case the company require less amount of working capital, but the fixed investment will be huge. Similarly, manufacturing policy, if a manufacturing policy is continuous, you require more working capital. But if your manufacturing policy is ha- having some hold, like you are producing not throughout the year, you are producing during the seasons. So during the season you require more working capital, during the off season you require less working capital. Credit policy, the policy which you give credit to customers. This is called credit policy, which you are giving to customers. If you are very liberal to the customer, your funds are blocked and you become more working capital. But if you are very strict with the customers, you are not giving too much of credit to the customers. So in that case, your funds are not blocked and you require less working capital. Supply credit, that means when you purchase something from your suppliers, whether your suppliers are giving more credit to you, if suppliers are liberal. So if suppliers are liberal, we are having more time for making payment and we require less working capital. We require less money on hand. But if your suppliers are strict, your suppliers require money to pay and then they will give you raw material, in that case you really need more money on hand, the cash requirements will be high and working capital requirement will be high. Operating efficiency, if your production is having efficiency in operation, that means less number of wastages, machines are good, labors are efficient, skilled labor, proper repair and maintenance are done for machines, so less breakdown of machine, your production cycle is going very smoothly, so you require less working capital because your wastages are very less, and vice versa. If your operating efficiency is not good, your wastages are more, your money will be wastage in more raw materials and you require more working capital to purchase raw material again and again. And the last factor which is also important while deciding the cash on hand, working capital on hand, is inflation. If there is high inflation, definitely you require more working capital because the price of raw material will be high. If inflation is high, material will be costly, labors will also be costly because the labors will require more wages, they require more salary, and you need to have more cash to make payment. So these are the points which will keep in mind while deciding the working capital on hand. There are some companies which are estimating, so factors we are aware now. How to decide how much cash I should keep on hand? So there are other tools also, techniques also, where companies are using to estimate, to predict the working capital requirement. One is current asset holding period. What companies are having policy, the current asset holding period is longer, 2 or 3 months, the company require more working capital, like 2-3 months cash on hand. But if company's current asset holding period is lesser, like 15 days to 1 month, companies are able to convert asset into cash, so companies require less working capital. Ratios to sale, some companies are deciding, like if the monthly turnover of company is like say 10 crore, so this 10 crore, and some companies are keeping 10% cash to run the factory. So if your monthly turnover is 10 crore, 10 crore into 10%, companies keep 1 crore on cash on hand. And some companies are keeping working capital, which is last to estimate the working capital based on % of fixed assets. So if companies are having fixed assets, the investment, total investment of fixed assets are, let's say, 400 crore, and to manage this much of big companies of 400 crore, some companies are keeping 1% of fixed assets, 5% of fixed assets on hand. So let's say 4 crore, 40 crores you should always have on hand. to run, to manage such a big company, because there are some repair maintenance are happening, some accidents are going, or some sudden requirement of raw material are there, and because of that the working capital requirement can also be decided based on the percentage of fixed assets. There are of working capital finance policy. One is called long term policy, short term policy, and spontaneous. Whenever you need fund, you can always approach long term source to have fund. Whenever you need fund, you can also go for short term approach, or whenever you need fund, you can have spontaneous on the spot. Let's see, have look into details. This can also be understand by matching approach, conservative approach, and aggressive approach. To understand this, let us understand with the help of graph. This graph, as you can see, the permanent working capital, which is a straight line which is moving up, and when we talk about temporary working capital, there are temporary working capital again of two. One is called straight line which is moving up, one is zigzag. Now what is matching approach? As you can see on right hand side, there is long term financing and short term financing. As per matching approach, permanent working capital which company require every month, which is fixed, should always be matched with the long term financing. You should never go your fixed requirement from your friends and relatives. You always try to get this one from the long term source like long term bank loans, etc. And the temporary working capital is requirement only for 2 months, 3 months, and maybe for 6 months. So for that you cannot go to bank and have a bigger burden. You should always approach the short term financing. As you can see on the right hand side top of this graph, short term financing like short term loans, bank overdraft, CC, credit limit, loan from friends and relatives. So this is called matching approach. Short term requirement will be matched with the short term source, and long term requirement should match with the long term source. This is called matching approach. The second approach is conservative. Conservative is not taking risk. Whether it is a long term requirement or it is short term requirement, company never go for short term financing. Company always go for long term financing. That means whether it is my long term requirement, 6 months requirement, 8 months requirement, or whether it is my 2 month requirement or 6 month requirement, short term requirement, I always go for long term financing. I will never go for loan from my friends, relatives, or credit limit, because these are risky. Then the rate are very high. And the last is aggressive approach. Aggressive approach, the companies always try to have last moment finance, which is spontaneous also. So whether it is my long term requirement or my short term requirement, I always go for short term financing, which is on the spot, on the last moment. I'll try to manage out. I never go for planning. Whenever I need fund, sudden fund, I approach bank for cash credit for my friends, relatives. The risk is maybe I'll get the fund from my friends, relatives, and short term financing like credit, bank will pass my credit, CC. But if bank is not approving, or my friends and relatives, if I'm not getting short term financing from them, my business will get hold. There will be problem in the business. That is why this is a risky approach, which is known as an aggressive approach. So these are what the working capital management chapter is. For more details and from other chapters or other concepts, you can always visit my YouTube and blogspots. Thank you very much for the listening. Thank you.